Let's get some more market insights with Skyler Weinand, who's the CIO at Regan Capital. Skyler, great to have you with us. And so, you know, the Fed's messaging has been pretty consistent so far, right? They want to see more convincing evidence of the sustainable return to 2% inflation. Lisa Cook also mentioned that they do expect inflation to slow more sharply next year. Do you think when you take a look at what rates markets are pricing in right now that 300 basis points of cuts by March is realistic?
Now, there are some folks that are putting that trade on, but if you look at the curve for the next 2.5 years or so, it's about 8 Fed cuts that are priced in. About 3 over the next 6 months, and then another 4 in the subsequent, call it year or so. So September is definitely on the table. December is on the table after that. And then it really becomes dependent on data. But yeah, we need another couple prints. We need 2 more prints at least on the jobs front and the inflation front for the Fed to open the floodgates, so to speak, in September. And then we could see multiple cuts between September and the end of next year. That's for sure.
For equity investors, is there any reason to veer away from the narrative of American exceptionalism?
I don't think so. Consumer balance sheets are extremely strong. Corporate balance sheets are extremely strong. The debt level, the interest expense for U.S. corporations is actually lower today than it was a couple of years ago, even with rates as high as they are, because corporations are smart. And they locked in low interest rates post-COVID. They refinanced, they took out a ton of debt, and their interest expense right now is as low as it's been in a couple of years. So corporates are in an extremely good position. That includes high yield. Leverage levels are low. And then if you look at U.S. consumers, U.S. wealth has grown $40+ trillion since 2020. From 111 trillion to about 151 trillion today.
And all of that money will get spent at some point, right? I mean, there's so much sitting on the sidelines at a time when we're headed towards a presidential election. And we know that no matter who wins in that presidential election, we will see more spending. Is that a cause for concern, given that we're expecting inflation to fall? How will inflation fall if we continue spending?
If growth wasn't there, that spending would definitely be a concern. But you have housing that's grown 13 to 15 trillion in the last 4 years. The U.S. stock market alone, the total market cap's up $11 trillion since November 1st. So when you compare U.S. government spending, deficit spending of maybe $2 trillion. You have credit card debt at, $1.5 trillion. You have student loan debt at about $1.5 trillion. All that really pales in comparison to the amount of equity that's built up, whether that's in housing or whether that's in equities. Folks that have this money sitting there that could be tapped if and when they need to spend it. Now, the economy is very bifurcated. So asset owners have done extremely well. The folks that aren't asset owners, that don't own homes and don't own equities, they're in trouble. And so the Fed is paying very close attention to those folks, to Main Street, to bring inflation down. They aren't even thinking about raising rates until they see inflation, I think, hit right around 2%.
You sound like you have very strong conviction when it comes to the U.S. market and also a soft landing for the economy. Are there any other markets out there that give you such high conviction as well?
We see the yen at 160. I had to squint, and go back to 1990, 34 years ago when the yen was at 160. Okay. So Japan's doing okay, absent the high levels on the yen. But generally speaking, inflation's coming down in Japan. What they're doing there is working, okay? We look at pockets like Australia, especially India and Pakistan, developing countries where, whether it's cheaper labor or cheaper places to do business, are doing extremely well. So looking at Asia, it's very country and region specific. you can't include China with Japan, obviously. So Japan looks good. India, Pakistan, Australia, okay. Europe's actually coming back. Some of the signs in Europe are showing that they're showing signs of life. Inflation is abating. What they've done thus far has worked in order to slightly turn the economy around. But yeah, the real growth engine is going to be, the AI revolution, which is, primarily in the U.S., but a tad bit in Southeast Asia.
A couple of sort of like honing in on what you've just said. What do you like in Australia, and what would it take for you to change your conviction against China?
Speaking to China first, we need to see the property boom there. We really need to see that kind of play itself out. There was a tremendous amount of cash in debt built up in building, property. I think we're maybe only in the second quarter out of 4 of seeing that really play itself out. And then, we have onshoring, we have the Russia-Ukraine conflict, where we really don't know what side China is going to come out on. And that could take 5 years for it to really, really shine through. As it pertains to Australia, you talked about them thinking about, cutting at their next meeting. And so they're showing some green shoots there relative to the U.S. where, hey, look, we may need to really tamp down inflation in order to bring the economy into, control, so to speak. So, I would be looking at outliers, like a Pakistan or like an India that have done extremely well this year, to make a bet, so to speak. But if I'm a retiree, I'm probably placing my money in a Japan or in Australia if I'm in Asia.
I see. What about the tech story? Because we continue to see this rally in the Magnificent Seven, but you mentioned some of those geopolitical risks out there. We're now hearing that OpenAI is taking additional steps to curb China's access to artificial intelligence software. I wonder if all this bifurcation and divergence and just clashes when it comes to tech hardware, semiconductors, now artificial intelligence software, how is that going to impact the sector long term for an investor?
Well, there's a tremendous amount of R&D spending that is going into AI. We see Meta, Facebook, that have turned from the Meta universe. Maybe they'll rename themselves AI Book from Meta, because they've switched away from the entire concentration on Metaverse to, hey, we're going to spend this money on AI, and Meta's done extremely well since then. So, focus on the hardware for right now, but we're only 2 to 3 years away, I think, before the software aspect, this Microsoft versus Meta versus Google, where that really comes to fruition and it starts replacing jobs. Okay. And so that we'll see this huge catalyst, I think, on the software side, whereas right now it's primarily on the hardware side.
Skyler Weinand, good to have you with us, CIO at Regan Capital, with his market calls, and a reminder of our big guests.